I'm Charlotte McLeod with the Investing News Network, and here today with me is Larry Lepard, Investment Manager and Managing Partner at EMA. Really good to be picking up with you here online. Our last conversation was all the way back last October when we were in New Orleans, and hopefully we're going to pick up on some of the themes that we touched on there. A big focus of that conversation was your thesis surrounding the economic debt doom loop. And I think to put it lightly, we haven't seen that situation improve since then. So, no. And I wondered if you could begin by situating us there and telling us how that's developed.
Sure. Let's see, from last October to present. I mean, probably the biggest thing that's happened is we had kind of a mini banking crisis in the United States. Everyone's familiar with that. Silicon Valley Bank failed, and rather quickly and rather spectacularly. I mean, to me, one of the most shocking things about that was the way that $42 billion got sucked out of that bank in one day. I mean, this is not the Bailey Savings and Loan, right? The next day they asked for $100 billion, they didn't have it, and so they were shut down. So what that tells me is that contagion when it occurs can happen very quickly, kind of at scale. And we're living in a world of instant communications. I'm talking to you across the continent on a computer, and everybody knows everything very quickly. So when something happens, it can contagion can spread, and we'll come back to that in a moment. I think that that's to me what a symptom of what I call and have written about in my quarterly letters, which are available on my website. I call this rivets popping, which is to say that the monetary system is being stressed like it's never been stressed before. It's kind of, we've got these big swings going on about, what is money and how is the money managed. And, as far back as 2018 with the repo crisis or 2019 with the repo crisis, 2018 with the Powell pivot, 2020 with COVID, and so on and so forth, we continue to kind of see very radical moves on the part of the central banks. We had zero interest rate policies for a long period of time. They tried to stop it, and that led to the taper tantrum. Then we had a repo blowout, and that led to another return to zero interest rate policies. And then we had COVID, which was the kind of the mother of all prints post 2008, and of course the balance sheet went, Fed balance sheet went up to to $9 trillion. They've since then been trying to taper. As we all know, Powell jacked up rates as quickly as he possibly could, because he was way late in fighting inflation, calling it transitory when it obviously wasn't. And this new move of higher rates has really started to cause monetary distress in a lot of areas with a lag. And we didn't really know what areas would be impacted first. Obviously, we discovered in March that one of them was the banks. Banks who had taken on long duration bonds at low interest rates. When their funding costs went much higher, they suddenly were deep underwater and, in fact, had negative equity. And that's what led to, the Fed coming in with their most recent Band-Aid program, which is, buy the paper, BTFP, bank term funding. I call it buy the effing paper. And so they, they've been trying to kind of address these rivets. I can't recall. I think when I saw you in New Orleans, I think at that time the British pension funds had their issue, and they had reversed their policies. And I think since then we've seen other signs of stress in the markets, not in the equity market, but more in the bond markets. I mean, bond markets have not been doing well, and that's because the inflation isn't transitory, and bond investors are saying, I need higher rates if you want me to hold these things. And more recently, probably the biggest thing I've noticed is that the U.S. federal deficit has really been trending in the wrong direction. It's now kind of looking like a print of around $2.2 trillion, which compares very unfavorably to the prior year of $1.3 trillion. And I think it's on its way to 2.5, 3, or 4 trillion, all this building on kind of the debt loop and the debt doom loop. And, on another show, I recently showed a chart that had, and it's on my Twitter feed, anyone go see it. It showed how much of the duration that's in the U.S. federal deficit or federal bond market is short. And what do I mean by that? I mean that we financed a lot of our deficits with 1 year, 2 year, 3 year notes, and sometimes even quick, shorter 3 month, 6 month notes, and those roll over obviously quickly. The 1 year, a lot of the 1 years are coming due. I think, as I recall, the number for the next year is $6 trillion, If you add to that the deficit of $2 trillion, that means that the U.S. federal government needs to sell $8 trillion of debt, before they start quantitative tightening. And the quantitative tightening is obviously reducing the debt as well by roughly about $100 billion a month. And so, that what that means is that there's a lot of U.S. debt for sale. And at some point, the balance sheet of investors and the world and other central banks is going to be tapped out, and interest rates can only do one thing. If there's more debt for sale, there's less demand to buy it. Well, then that means the price of the debt, the interest rate, will have to go up. And so as a result of that, then, that feeds back into the U.S. federal government deficit. And another chart I often refer to is the chart of the U.S. federal government debt expense, interest expense per year. And if anyone, that chart's widely available on Twitter, just Google it. And what you can see is that, 4 or 5 years ago, we were spending $200 or $300 billion in interest at the U.S. federal level. And now it's 800, tracking towards 900 or $1 trillion. And that's because the interest rates are going up so rapidly that the cost of financing our $32 trillion, well, more than 32 now, since we just went through the debt limit. And there's another interesting story in the whole debt limit. They in theory, they didn't really put a limit on it. They just said, we're going to keep it open. There's no limit right now. It's going to be open for 2 years, and then we'll address it. And so I wholly expect that, I think that they're going to address it in Q1 of 2025. So that's almost a year and a half away now. And it strikes me that, by the time we get there, we'll have $36 trillion of debt, or some number that's significantly larger than what we've got right now. And this really is the problem, Charlotte. They just can't stop spending money, and they print money. Well, more recently they haven't been, but in general, ultimately they end up printing money to cover these costs and these deficits. So, and that's why, to me, the inflation is very intractable. And even the higher interest rates aren't going to solve it. Arguably, the higher interest rates could be making it worse, because part of the debt issue, or the inflation issue, I should say, is a supply-driven piece, and the supply gets addressed by capacity expansion. Capacity expansion requires capex. Capex is more expensive when interest rates are higher, so people are hesitant to make the capex investment if it costs them more. So we've really kind of got ourselves into one hell of a mess, and the Fed is really pretty well trapped. And I think the implications for that are that, one needs to hold sound money assets, in spite of the fact that until rather recently, they weren't looking all that great because of the Fed's tightening campaign. But more recently, gold has actually kind of hung in there, and Bitcoin is actually the best performing asset class year to date in 2023. So two sound money alternatives have been doing okay. The part that frustrates me, and probably a lot of your listeners as well, because I know you're in Canada, is those of us who own the gold and silver stocks are kind of asking ourselves, what's wrong with this picture? Gold is held in there pretty well, and yet the stocks have really been kind of just lagging. And I credit this really to the issue of the fact that right now the U.S. stock market is doing pretty well, and the narrative is that we're going to have lower inflation and you don't need sound money. And I think that narrative is going to be proven to be in error. But, it has right now, people are not too concerned. And so as a result, we're in one of those periods where, after a very big run up in the gold stocks and gold from 2018 to 2022, or 2021, I should say, the peak was in 2020. We're in a correction, and it's annoying and frustrating, but I don't think the fundamental trend has changed. In my opinion, we are in a strong bull market for gold and silver, and gold and silver mining stocks, and Bitcoin related stocks. So, and this is all due, in summary, this is all really due to the government malfeasance. I mean, they are in a situation where they just cannot stop printing money. And so I think the market is saying they're going to have to go back to that not too far out.
All right. I think you've given us so many different directions that we can go down here. So let's try to sort out the different trends.
Where do you want to go?
Let's go back to the banking crisis for just a moment, because you mentioned that right at the beginning as this key event that happened between when we previously talked and also right now. And then you're also talking about the lack of concern among investors right now. And to me, we had this banking crisis happen. Everyone was very worried about it for a while. It was really in the headlines. And this seems to happen a lot where these major events happen and then they fade away and we kind of forget about them. So maybe we can talk a little bit about that, because I know that in the back of their minds, a lot of our audience at least is wondering, okay, this can't possibly be the end. And yet it seems to have fallen from people's
Yeah, I mean,
minds.
I have the same reaction, and it's kind of amazing how in this soundbite and media driven world, like there's one thing that happens, and then everyone moves on, and something else is the new narrative and the new story. Um, you know, couple things. One, let me credit the authorities with doing a pretty good job of calming the herd down and preventing panic and putting in a policy that saved some of the banks and forcing other banks to take, put deposits in to shore them up. I mean, I'm not sure how many of your listeners know this, but the Fed basically went and leaned on the big American banks and said, you're going to make deposits into First Republic to save it. And so they're pretty good at, a problem pops up and it's whack-a-mole. They'll whack it and solve it for a while. And everybody calmed down and realized that, all right. And they said that if necessary, they were probably prepared to back the banks that, the deposits that were over $250,000, which is kind of the limit in the United States where you're protected. And so, everybody calmed down and life went on and we're all good. It reminds me a lot of the period in 2007 where, and eight, in the summer of 2007, a couple of the Bear Stearns hedge funds that were dealing with the CDSs and the mortgages in the United States blew up very quickly. And a lot of us said, oh, here we go. This is the end of the housing bubble. And we were right. We were fundamentally right. But that was July, August of 2007, right? And then in March of 2008, Bear Stearns itself blew up and went, was kind of cratering and was forced to do a merger at $2 a share, which they subsequently revised. But so these were underlying problems in a leverage system that had a fundamental flaw in it, that led to the GFC. Well, you recall, it's the summer of 2007, March of 2008. GFC occurred in September or October of 2008. So to me, what we've got going on here are kind of early warning signals. I don't know, call them maybe tremors in front of the big earthquake. And I feel like the earthquake is coming. And the reason I feel very certain that it's coming is that we have an entire world built up on leverage and based on 0% interest rates for a very long period of time. And as a result of that, a lot of malinvestment got made, a lot of bad economic decisions got made. And what we're just starting to see the impact of those, right? We saw the impact at Silicon Valley. They're bankrupt. They bought the wrong stuff. We're seeing the impact in some of the commercial real estate. There are major landlords in some big cities who literally walked away from buildings. They had a $200 million building. They had a $120 million mortgage on it, whatever the number was. Suddenly they realized the building's not even worth the value of the mortgage. Here are the keys. Okay, lender, you own the building. We're gone. And so you're seeing things happening that are problematic, but they're isolated. And in the case of the banking thing in March, I thought it would continue, and I have to say honestly, I am somewhat surprised that everything's kind of calmed down. But it doesn't really. I mean, it was interesting because it hit all the normies, and the normies were, I had people who had no knowledge of finance, none, zero. And, there was a bank run, or not a bank run, but there were big lines outside the banks in my town. And so some of these very unknowledgeable people said, what the hell is going on? I mean, this looks like a wonderful life, right? But once, the authorities kind of said everything's okay and everything appeared to be okay, everybody calmed down. And so, once again, I mean, it's each of these crises have different things going on. And the people who run the system are pretty good at kind of calming people down and convincing them the system is sound. And so, as long as your bank isn't going to go bankrupt, and, most people don't have deposits of over $250,000 in the bank as a practical matter. And so they're kind of like, okay, fine, applies to somebody else, not me, I'm good. Where it's going to start to hit home, in my view, is as the inflation really starts to eat away at the consumer and, more and more people start to, in a combination of either not be able to make the rent, not be able to pay for the food, not, lose their job because their business has slowed down. And we're seeing this, I mean, in small ways, but you're seeing it, in car sales, you're seeing it in house sales, you're seeing it in other things. And there's a lag effect between the time when, things change. I mean, the interest rates went up as much as they did, and the impact is felt. And so I think, I think the impact is being felt as we speak, and it's going to become very notable. I mean, right now, the standard narrative is that, the Fed has an inflation problem and they're raising rates to fight inflation. And that's fine. I mean, looking in the rearview mirror, they definitely do have an inflation problem. I think the Fed is about to have an economy crumbling, unemployment / nobody has any wealth, everybody's hurting problem. And at that point in time, and inflation, I do think, is going to come down. I mean, first of all, I think all the inflation numbers are bogus anyway. So, I mean, we're talking about something that they measure wrong, and et cetera, et cetera. And I believe inflation itself actually is persistent. But I think they're going to figure out a way to get the stated inflation numbers down, even if they have to cook them, so that, the next narrative will be, oh my God, XYZ company is laying off this many people, and ABC company is laying off this many people, and, no houses are getting sold, no cars are getting sold, and the economy is tanking because of these higher interest rates. And, oh my God, Fed, what are you going to do about that? And at that point in time, the Fed is going to have to reverse their policies. They're going to have to say, okay, we're going to cut interest rates. We're going to reverse quantitative tightening. I mean, and that, to me, actually, that's another potential area where the problems will surface. I think the bond market is actually going to be the problem this time. I mean, there's way too much debt in the world. There's not enough debt carrying capacity. And I think the bond market is going to eventually, cough up a hairball and say, yeah, I get it, U.S. government, you want to sell that much debt, but we don't want to buy it. And so, we're not buying it at those rates. The rates have to be significantly higher. And boy, in a leveraged economy like the one that we've got, if interest rates go to 6, 7, 8, 9%, look out. I mean, that's going to have a big economic impact. And so I think that will happen. And at that point in time, the Fed is going to realize they've gone too far in this direction. I mean, very much the way that they've missed the inflation, and they went way too far. I mean, it was very obvious. I mean, obviously, I understand why they did what they did when COVID hit. I get it. They had to do something. But they continued it for quite some time. And when mortgage, housing prices were ripping higher, and you had, remember back in 2021 and we had people standing in lines. There were bidding wars on housing. And yet the Fed was buying all kinds of mortgage paper and adding more and more money into the system, and they shouldn't have been doing that. They went way too far that way. And of course, then the inflation surfaced, and oh my God, we got an enormous inflation problem. Let's tighten up like crazy. Let's take rates up at one of the fastest rates in history. The only person who did it fast was Volcker, and so here we are. We've gone from 0% interest to 5% interest in a record short period of time. And they've hinted that they may go even higher, and they may feel like they have to, right? And so that's fine, but the problem is that's going to cause a different set of problems, right? And they're still fighting the last one, and the last one will eventually be dissipating, and the new one will be on the surface, and then they'll reverse course and go the other way, and they'll start printing money again, and of course, then we'll get the next wave of inflation, right? So you've kind of got, I like to say, you've got these guys driving this clown car, and they're bouncing off these guardrails of extreme inflation or extreme deflation. And they need to drive the car down the middle of the road, but they don't seem to be able to do that. So the sad part is that it makes it very hard for all the rest of us, because we're just trying to live our lives, and we'd like to have some predictability. We don't want to stand in line to buy houses. We don't want to have massive inflation. We just kind of want a stable price level and a stable economy. And that's not what's being delivered, because these guys are really, very poor, in my opinion, at the way that they run this. And some people say it's intentional, and perhaps it is, but leave that aside. The fact of the matter is they're making they've made extreme movements, and in my opinion, they're kind of quote unquote breaking the money. The prices, the money itself is supposed to be a stable thing, and prices are supposed to be stable. And as anyone who lives in this world can attest, in the last 3 or 4 years, prices have not been stable. I mean, they really have not. It's been one hell of a mess, and frankly, they're to blame. And if you look at some of the charts on Fed credibility, it's at record lows. And I think it's going to be very hard for them to get this back under control And to me, the measures of how much out of control it is are the price of gold, the price of silver, and the price of the Bitcoin, well, and the price of oil. Right? I think energy, I've come to view, I with some other people who are in this area, very deep macro thinkers, I've really come to view energy as money. I mean, energy is the one thing we all need to run the world. You've got to have energy, and it's money. And so the price of energy needs to be stable to have a stable economy. And the price of energy is not stable. Money is not stable when you have it manipulated in the way that the Federal Reserve and the other central banks manipulate it. So that's kind of the big picture.
Right. And I think that opens up the door for us to talk about de-dollarization and that theme, which is another one that seems to
it's a great
be waking up in the mainstream.
Yeah, it's a great theme. As you know, there's been talk about the summer having a BRICS currency, and as you know, the dollar is shrinking in terms of its share of trade. And look, I think that there's no doubt that other countries and other currencies are going to play more and more of a role. And I think the big one on this whole de-dollarization theme, I mean, to me, the one that's really most notable is when the U.S. decided, when the war broke out, when the Russians invaded Ukraine, that war broke out, and the U.S. decided to seize their assets. That was an enormously short-sighted and stupid move, in my opinion, because what it more or less said is to the entire world is, if you have dollar-based assets within the dollar-based SWIFT system, and you do something politically that the United States doesn't like, they can just grab it. They can be almost like thieves. And gosh, okay, fine. So maybe, it has a certain implication for Russia, but I mean, India sees that, and China sees that, and Brazil sees that, and the Saudis, everyone else sees it and goes, maybe I don't want to hold dollars, And so, and it weakens the dollar. It weakens, and what that implies is, of course, that implies a weak dollar means more inflation for people who, in America, people are in Canada, who are basically dealing with the dollar standard. It makes everything, if our dollar falls in value relative to assets and things in the rest of the world, our stuff costs more. So we have more inflation. And so it's really an important thing. And the BRICS currency, look, I mean, the announcement of that, I think, is meaningful. Actually pulling that off and making it work, I think it's going to be difficult. I think it's going to take time. The dollar's not going to go away anytime soon. I mean, the dollar is widely understood, recognized, etc. But I think it's important, as others have pointed out, to view currencies as really having two roles. There's the exchange role. I mean, look, you can be in any other country and dealing in your own currency. And if you deal with somebody who wants dollars, you say, fine, I'll convert my currency to dollars. I'll do that transaction. I'll bring whatever I bought back. Then I'll go back to my currency. I mean, FX is very open, liquid, and FX rates are very well known. So using a currency to do a transaction doesn't mean you necessarily endorse that currency. It's just a tool you're using to make a transaction occur. What really matters, in my opinion, is where are you going to store your money? Okay, what do you believe has soundness on a longer term basis? And it used to be that the dollar was very sound, and people would store their money in the dollar, and treasury bonds were the soundest form of interest yielding securities. But I think what's really starting to happen is that people are coming to see that the U.S. government is being very irresponsible, and the dollar is losing its reserve currency status, and therefore, it's not necessarily a smart thing to store your excess energy in the form of dollars. That gold is an alternative, Bitcoin is an alternative, oil is an alternative, perhaps other currencies are alternatives. And so, all of those things, to me, what really matters the most about the dollar is not how much it's used in trade, because it could still be used a great deal. It's a matter of, do people trust it? Are people willing to store value in it? Because we're in a situation where we run twin deficits. We run a deficit on a trade basis, and we run a deficit on a government basis. So that deficit needs to be funded with debt. And if nobody's going to buy that debt, that's a problem. That's a significant problem, because it leads to higher interest rates, and that has a whole series of implications in the economy. So in my opinion, what will happen is you're going to see these other things emerge, and you're going to see the dollar slide. And the dollar index right now is 102. I could easily see it down into the 90s or 80s. And, America, I mean, one of the things that having the reserve currency has allowed America to do is live beyond its means and have low inflation, because we could export inflation to other countries. And I think that power is going to go away. because I think the world is coming to see that the American fiscal situation is not healthy, and that we, I said it in the presentation I made recently at another place, which is that, America's starting to kind of behave more like a third world country, where we are actually running large deficits, and then we're going to be forced to cover those deficits by printing dollars, even though in this brief period of time we don't appear to be doing that, because Jay Powell is trying to be Volcker. I think his hand is going to be forced, and I don't think it's going to be long. I think within the next year, probably a lot shorter, his hand is going to be forced, because we just can't continue to run these deficits and expect that the world is going to buy our debt, given the deficits that we're running.
And so for you, when you look at this situation, I know you're a big advocate for sound money, which includes for you gold, silver, Bitcoin. I'm going to start with a couple of questions on gold and silver. I think that, so for our audience, when they hear about all these circumstances that are building, they want to know, okay, so where are the prices going for gold and silver? And then, yeah, exactly. And then as you already were speaking about at the beginning, they wonder, gold, of course, the price it's down from where it was earlier this year, but still very elevated. They want to know my gold and silver stocks, what are they?
Yeah.
So any comments?
Yeah, those are great questions. Look, I wish I knew too. I mean, it's been very, very frustrating, particularly in the stocks. But let me take the metals first. I mean, the metals, in my view, even though it doesn't feel like it, they've actually held up pretty well. I mean, 4 or 5 years ago, gold was at $1,600, and it's now I guess it's at $1,900. It's bumped up against 2050 a couple of times, and it's not as if gold is falling apart. It's just not going up the way it went up when we had the big print. It went up very sharply from the 15, 16 level up to 2000. When the big print occurred in 2020. And with interest rates going up the way they're going up, typically what that would mean is that gold would go down. The interest rates going up means the real interest rate is getting less negative. It's quite negative because inflation's high, but the real interest rate's getting less negative. And in general, that means that gold goes down. And it hasn't. I mean, it's gone from 2050 to 1900. It's down a touch. It's a skosh. It's still very close to an all-time high. It's bumped up against it 3 times. I strongly believe that gold will take out 2100 and it will rip to 3000 when the first hint of the next easing occurs. And I think that's not very far away. So, and then of course, silver is gold on steroids, as we all know. And I think silver will go through 30 easily and on its way to 50 and then through 50. I mean, it's amazing to me that silver is the one commodity in the world that's never beaten its all-time high. The last time it was at 50 was 2011. Before that, it was the Hunt brothers in the 80s. So, and I think this time silver will easily take out 50. So, when we get the next wave of inflation and the central banks pivot based on, inflation, I mean, look, that's the other thing. They're going to kind of define what's acceptable inflation up. It's been 2% has been the target. I mean, you've seen them floating a few ideas like, well, maybe 3 is okay, maybe 4 is okay. And so I think we're going to get a little bit lower inflation and a lot more unemployment. The economy's slowing down, and they're going to pivot with elevated inflation. And when they do, gold and silver are going to take off like rockets and go to much higher numbers. And so to me, that's really the key to then affecting the stocks. Now, the stocks are gold and silver mining stocks are very levered entities, and they're very much driven by expectations of future gold prices. And it's interesting because I interface with a lot of people in Toronto who are in the gold and silver stock business, and I interface with their analysts, and I look at a lot of the projections. A lot of the major banks in Canada and other people around the world are kind of predicting gold prices 2, 3, 4, 5 years out will be 1,600, 1,700, 1,800. I don't think there's any chance of that. I think there's almost zero probability of that occurring. But I think that's what the stocks are sniffing out. And the stocks are saying, well, okay, the ASIC, ASIC is the operating cost to pull an ounce out of the ground, right? And the ASICs have crept up from 900, 1,000 to kind of 1,200 maybe as an average today. Some are higher than that, to 1,300. And so at $1,900 gold at 12, you're making $700 an ounce. It's got to pay to find the new ounces, and it's got to pay for the capex. But that's not a bad margin, to be honest with you. I mean, the industry's been in a lot worse shape. And, we all know the costs are creeping up, so that ASIC goes up every year because there's inflation. And really, the gold stocks do well when the price of the metal is going up faster than the ASIC is going up. And right now, the price of the metal is kind of flat, and the ASIC price is going up. And that's what's really, that margin compression is what's caused the gold stocks to be really punk. And it's frustrating. I mean, honestly, I was talking to a couple of gold mining executives yesterday, really very well-known guys who've been very successful. And they said, Larry, this is the worst I've ever seen it. I mean, this is almost worse than 2015. I got to tell you, I've been in the trade since '08. I've been buying gold stocks. 2015 was horrible. I mean, absolutely horrible. And it kind of feels that way to me now. And I've said this on other interviews. I mean, I feel like puking. When I look at my gold stocks and the prices they're at, my performance in my portfolio, it's like, I want to puke. This is awful. And I've only felt this way a couple of times in the past. I felt this way in '08 because the gold stocks went down 50%, in 3 months. I felt this way in 2015 after the bear market that started in 2011 kind of bottomed in 2015. Oh, it was awful. 2015 was just dreadful. And I felt this way in March of 2020, very briefly, when the COVID thing came and everything plunged, including gold stocks. And I had, the exact same thing. And so, if that's any indicator, when you feel this bad, I don't think it can get much worse. And so, and these things are totally sold out, completely sold out. They're insanely cheap. I mean, I was researching a company yesterday. The company has $150 million of cash on its balance sheet. Now it's got some debt too, a similar amount of debt, but market cap on the company is $60 million. I mean, this makes no sense. I mean, I've got companies that trade at 3 times cash flow. I mean, investors are treating these stocks as if gold will never go up again. And look, gold stopped going up when Powell started tightening things, and as long as he's tightening things, and as long as he's saying inflation is going to come under control, and as long as he's saying you don't need the protection of gold, there's a certain part of the population that believes him. Now, I don't happen to be part of that population. I think he's wrong, and I think the market's going to show them that he's wrong. But for now, that's kind of what people are thinking. So, to me, I mean, they say bull markets try and throw off all riders. Well, anybody who can ride the gold and silver stock bull market that we're in right now, my hats are off to them, because I got to tell you, I'm a professional at this, and it's hard as shit. I mean, it really sucks right now what's going on. Having said that, I also know, and because I've done this before and I've been through a few of these cycles before, that I really strongly suspect that in 2 or 3 years, I'm going to be saying, thank God we hung on. And even thank God, I mean, there's some things I'm buying. I sell some of the more expensive stuff to buy some of the cheaper stuff. It's like, Jesus, thank God I made that buy. It's up 5x from where I bought it. I mean, I think that's in our future. But, by future, I mean, that's 2 years from now, maybe, to get to 5x. I mean, but I can tell you they're so beat up right now that if the Fed were to come out tomorrow and say, you know what, we're done raising interest rates. That's it. We're not going any higher. We're just going to stay flat for a while. My portfolio would probably double. I mean, it just a neutral, just a pause, because what they've done is they've skipped, but said they're still going higher. And so you have to remember, that people listening to this tend to be, self-educating and are different than the average people. Average person believes what the Federal Reserve says. I mean, they really do. And so, the average, investment bank parrots what the Federal Reserve says. And so, and I've got banks in Toronto telling me gold's going to be $1,700 in 3 years. Well, if gold's going to be $1,700 in 3 years, you're right. The gold stocks don't look so great. But I think, I honestly think in 3 years, gold's going to be $3,500. And if that's the case, these companies are going to be just throwing off cash like you read about. So, it all kind of depends upon your perspective and who you believe. If you believe Jay Powell and you believe their narrative, okay. So like a lot of things in life, Charlotte, you can look at this and think, all right, this really sucks. My stocks are down. Or you can look at it and think, oh my God, they are giving me an opportunity to buy really high quality companies at really cheap prices. I have some assets over in the stock market that happen to be, in my opinion, stock markets are very overvalued right now and are quite vulnerable. Maybe I should sell some of those assets, which are expensive, and I should use the proceeds to buy some of these gold stocks, which are insanely cheap. Do you know what I mean? And so there's an opportunity here, right? I mean, what I've got sucks. It sucks that, what I've got is down, but in turn, that's also, Mr. Market has given me an opportunity. And that's what Buffett has always said. And that's how he made all his money, which was, he said, you want to be bold when others are fearful. And in gold stock land right now, everybody's fearful and depressed. And you want to be, cautious when everyone else is all bulled up. And, you look at the US stock market right now and NVIDIA and all the AI trend and, those gauges of fear and greed. I mean, it's like extreme greed. I mean, everyone's just like, oh my God, I got to get in on AI. Right. And my opinion is that's going to end very badly. That's going to end very badly. Those people who chase it are not going to be rewarded for doing that. I mean, that pattern repeats itself over and over again. And in turn, if you take the time to understand the good gold stocks and you buy the really good ones when they're this cheap, you're gonna make serious money, as it becomes clear that the Federal Reserve really can't stop printing money. And that's the underlying thing. You have to understand the structure of the macroeconomy. You have to understand the structure of the debt situation that we've got. And when you do, you come to the conclusion that, their choice is between letting the economy collapse and printing money. And, admittedly, they printed too much, fine. They're tightening up, fine. They're not at the economy collapsing part, but we're starting to see what I call rivets popping. Silicon Valley Bank, Britain, with their problems. And there'll be more. There'll be more rivets popping. And then, eventually the rivets are going to get louder. The inflation issue is going to get less loud. The rivets popping is going to get more loud. And they're going to change their policies. They're going to start to print money again. And this shit that we're in is going to take off. I mean, the advantage of being older as an investor is it's kind of like you've seen this movie before. And I've seen this movie before, and I don't like it. I don't like being in the position I'm in right now where my stuff's not working very well. But I'm not a day trader. I'm not buying and selling every day, and I'm not investing for the next week. I try to put large sums of money in trends that I think are very sustainable. And I think the trend towards inflation is quite sustainable. And therefore, I think those of us who are in the sound money camp are going to be pretty well rewarded when the next wave up comes through, which, I expect to start within a few months to kind of worst case a year. I think, I don't see how this lasts much longer. If you consider the 2008 example, Bear Stearns fails in March, the crisis was in September. I mean, that was 6 months. So, let's say in Silicon Valley Bank failed in March, maybe today things happen faster because of the internet being more developed. Who knows? I would expect that the trouble will show up sometime, this fall, if not sooner. So, and that, that'll shove all this stuff up enormously. So it's very difficult though. I mean, let's not kid ourselves. It's extremely difficult to be mentally tough through this stuff. But I think you have to know what you own. I think you have to know why you own it. I think you have to ask yourself what you believe. I mean, let me answer one other question. I think it's important. Somebody asked me the other day on another podcast, so how could you be wrong? What's the alternative side? What's the counter argument to your argument? The counter argument to my argument, and people will laugh when they hear this because they'll realize the odds. I think, like me, they'll think the odds of this are quite low. But the counter argument to my argument is that the U.S. federal government suddenly gets responsible, right, and says, you're laughing, right, and says, all right, we're going to means test Social Security, we're going to cap, Medicare, we're going to reduce Medicare and Social Security benefits. We're going to reduce our military presence in the world and take our military spending down. We're going to increase taxes, and we're going to balance this budget. Okay, we're going to suddenly, U.S. federal government is going to run with a balanced budget in a responsible manner. Okay, now as you might be aware, trying to do that would be political suicide. Because right, and that's why I think the odds of that are quite slim. But if that were to occur, the thesis, what I'm talking about, would be less likely, and they could theoretically maybe put us on a more sustainable path. Having said that, I think we're beyond the point of no return because the debt's so large. Even if they did that, the burden of the existing debt is just bearing down on them, and I don't see how they can continue without additional monetization of that debt. I just don't see it mathematically. But that's the case. That's the bear case on my thesis, that the government gets much more responsible. And most people hear that and they laugh. They say, "Well, that's not going to happen." I say, "I agree." That's why I'm positioned the way I'm positioned. But it's not impossible. I mean, anything can happen, right? So.
Right. So you're right. When you do mention that, people probably start laughing all the time, which, should probably inform how they themselves and position.
Right.
So this is all really good information. I did want to make sure to bring up Bitcoin with you, which I think you mentioned a little bit earlier. And, I think you're a little bit of a rare, well, maybe not totally rare, but I know that among people who are interested in gold, they're definitely not always interested in or a fan of Bitcoin. So I was wondering if we could come at it from that perspective.
Absolutely. Yeah.
Yeah.
I'll try and help you on that because, and I understand. So you have to remember, I was in gold long before Bitcoin existed. I've been investing in gold since well before 2000, and I dedicated myself to gold in 2008 when the GFC happened and they printed all that money. I said, okay, I get it. They're going to inflate the shit out of this currency. I need to be in gold and silver. Bitcoin was invented in 2008. I didn't even know about that. And so, I am first and foremost a gold and silver bug, and gold and silver have been money for 5,000 years, and they're incorruptible money. And I call them analog sound money because you can touch them, feel them, they're useful for jewelry, et cetera, et cetera. So Bitcoin, and I understand the animosity that a lot of gold people have for Bitcoin because they've been carrying the sound money flag for years and years and years. And here comes this technological development that's going to they think is going to mess them up, but it's not. They can actually coexist quite well, and they play different roles. And then in turn, there are a lot of other things around Bitcoin that sent them off the scent. There are all these shit coins, there are all these fake cryptos. There's Sam Bankman-Fried. There's all the people yelling and hyping and pumping the shit. I get it. I totally get it. And so if you're a sound money, old school gold person, you'd have a natural inclination to say all crypto is bullshit. Okay. I get that. But let me make a point that I think people should try to understand, and should listen to if they are a gold bug and they're skeptical of crypto, or skeptical of Bitcoin, I should say. And that is this. Bitcoin is actually a technological innovation, okay? It's something that never existed until it existed. And what is that technological innovation? Bitcoin creates, quote unquote, digital scarcity. If you think about anything digital, a CD, a movie, a computer file, a Word document, whatever, anything digital can be copied a million times, right? There's nothing scarce about anything digital. But a blockchain with a proof of work algorithm with an immutable nature to it, and all the other things, the halving and the difficulty adjustment, a lot of technical things. The guys who invented Bitcoin, the people, the anonymous people, and I think it was a team. I don't think Satoshi is one person. I think there are a bunch of people. And they realized that if they came public, that wouldn't help the cause. So they just put it out there and said, here's this thing we invented. See what you think of it. I think the Bitcoin blockchain, the Bitcoin innovation created, in my opinion, the first really strong set of protocols which allowed for digital scarcity. And this is a big deal. I mean, this is like, the printing press. And when it came along, nobody, a lot of people don't realize it, but that's a really big deal. Just the same way that a printing press suddenly did what somebody could do by hand, or a car did what a horse did, or, a telephone did what a telegraph did, or a telegraph did what, Pony Express did. I mean, you've actually got a way to have something be, quote unquote, digitally scarce and truly provably digitally scarce. And until Bitcoin came along, you never had that. It just didn't exist. And so as a result, you could create, something that people could own and work to get through mining of Bitcoin that, which involved energy, by the way. I mean, again, all money goes back to energy. And you could have a token, a marker, a ledger that said, I own 1 Bitcoin. Very similar to the way, people say, well, it's not tangible. You can't touch it. That's correct. But really, money is just a ledger. Money is what people agree, back in the caveman days, right? People were sitting there and they were thinking to themselves, they didn't even have gold, wasn't even money yet, right? But there were markings on walls of caves, and it was clear that they were keeping score. Like, okay, I killed 3 bison. How many did you kill? You killed 1 bison. Well, you know what? You owe me 2 bison. And so, money is social obligation, right? It says I can use my money and you'll give me something. You give me food, you'll give me gasoline, whatever it might be. You give me labor. I mean, it's a way for people to exchange value amongst themselves. And so, it so happens that gold became the soundest form of money because it was scarce and it was, tangible, and you could trade it and you knew what it was. But also, even before gold, people were just keeping score. I mean, if, we could say, I cooked 3 meals for you. Now you owe me 3 meals back. And that didn't involve any gold or any money. It was just a scorekeeping mechanism. And that's what Bitcoin is. Bitcoin is a digital entry that says, I've got one of these things. You don't. I'll exchange it for you, but you got to decide, we'll sign a price. What do I get in exchange for it? So really you have to accept that money is a ledger. It doesn't need to be physical. You don't need to touch it. It doesn't need to be a physical, tangible thing. And then you need to accept that this ledger is truly defensible and immutable and scarce, right? Because we all know that if money is seashells or money is sand, well, there are zillions of those, and that it doesn't have any value. I mean, the other reason gold works so well as money is there's not a lot of it around, right? So, it was hard to mine, and therefore we knew that if you'd mined it, you'd spent the energy to mine it. That was proof of work. So gold was the best money, and then Bitcoin comes along, and what it really, in my opinion, it really does represent a form of quote unquote digital gold, depending upon the adoption. Okay, if we all didn't agree it was digital gold, it wouldn't be digital gold. And so, as I've said in the past, there are 2 things that can destroy Bitcoin. One, it technically doesn't work anymore, i.e. the system breaks. And it's worked for 14 years. You got these core developers running it. There haven't been any breaches of security. It totally works. So I'm quite convinced that the technical risk is quite low. The other would be if people collectively decide, we don't care about this. We're not going to use it. There's no real, you say it has value, but I don't think it has value. I'm not going to use it. Fine. Okay. And that's your right. But the point is, and I used to be a venture capitalist before I got into this investing in sound money. The point is, dogs are eating the food. And what do I mean by that? I mean, people are using it, and every year more people use it. And you look around the number of addresses, the number of transactions, the number of use cases. In Nigeria, 20 or 30% of the people use it because the money there sucks. And this is how they actually exchange value with one another. They're using the Lightning Network to do it. So the point is, adoption is growing. More and more people are using it. So what have you got? You've got a digital system which has true scarcity and immutability, which is now becoming easier to use with the Lightning Network, and you've got more people using it. So, and it's easy to send. The Lightning Network, you can send, large amounts of value for less than a penny. Okay. The on-chain transactions cost more, but that's what the Lightning layer was invented for. And you've got more and more people adopting it, and we're in a digital world. I could send you $1 billion of Bitcoin if I had it, and you would have it in 10 minutes. If I were to try and send you $1 billion worth of gold, I'd have to get 10 Brinks trucks, and a bunch of armed guards. So the point is, it's instant settlement, it's final settlement, and it represents a form of money that we've never known before. So it really is a legitimate technical innovation. All the other shit, by the way, Ethereum, Dogecoin, that's all crap. That all has some guy at the top who pre-mined it, kept a lot for himself, and wants you to buy his shit so that he can get rich off of you. Bitcoin, there's no CEO of Bitcoin. There's no management team of Bitcoin. There's some core developers who collectively, monitor the system and make sure it keeps running in the correct way. But there really is nothing, there's nothing that can quote unquote change the 21 million cap. You'd have to have a large consensus of the people to do that, and nobody who owns it would ever vote to change it because it makes no sense. It would dilute their value. And so here you have a form of money that is digital, easy to move around, totally secure. You can secure it with 12 words. And as I say, it really is digital gold. And you've also got, you got 2 things going on. Both these things are going to go up in value. As we discussed earlier, money is being printed by governments, and they cannot stop. They just can't, because of the way the politics works. If they stop, they lose their jobs. And so they have to continue to provide benefits that they can't really afford. And the way they do that is by printing money. Okay. And that printing money dilutes the value of all the money held by everybody else. We all know that. So that's the base case. All right. That's going to drive the price of gold up, the price of silver up, the price of oil up, the price of commodities up. It's going to drive all prices up. It's also going to drive up the price of Bitcoin. But the thing that's going to make Bitcoin go up even faster than gold, and this is why Paul Tudor Jones calls it the fastest horse in the monetary debasement race, is that there's an adoption curve going on at the same time, right? So right now, maybe 10% of the world knows about and owns some Bitcoin. Probably, well, the world less, but I mean, 10% of the Western world knows about and owns some Bitcoin. Well, guess what? As more and more people come to know about it and think, this thing is outperforming gold, and it has outperformed gold since 2008, both on an IRR basis and on a Sharpe ratio, which is an adjusted risk basis, they're going to say, you know what? I should have some of this too. And my view is they're both going to go up. I mean, gold's going to go up, in the next couple of years, gold's going to go up 2x and Bitcoin's going to go up 6x or 8x. I mean, and the reason for that is just that this adoption curve drives, the Bitcoin. I mean, there'll be more and more people, and the younger generations like it better than gold. I mean, my generation, they own a lot of gold and they want to hold their gold. And I get it. I totally get it. And I mean, look, what's the negative of Bitcoin? The volatility, of course. I mean, gold's never gone down 70% a year, ever, in fiat terms. I mean, a big down year for gold is maybe 20%. And Bitcoin's had repeated cycles where it's gone down 70%. But the reason that occurs is we're still in that very early days adoption period where it's not widely distributed, and you get crazy excitement, and it goes on a big run to 68,000 and it gets way overvalued. And then, you get people dumping it and say, oh my God, that's crazy. It went so far so fast. It went from 5,000 to 68,000. That's nuts. It's a bubble. And they sell it and it crashes back down to 15. But the 15 was higher than the last cycle where the low was 4. And the cycle before that, the low was 1,000. The cycle before that, the low was 300. And so with each of these cycles, the highs are higher and the lows are higher. And so, and that's because there's more and more adoption. It's more and more widely spread. And so I can fully see where, not that far out, Bitcoin, which is now at 30,000 roughly, will be at 100, and probably gold will be at 3,500 at that point in time. And so what I try to convince people in my gold fund to do, and older people, and mostly because my client base is quite old, is to have a little bit of both. Fine, have 80%, 90% gold. But if you're not in Bitcoin, you're missing kind of the asset, which, although volatile, has a chance to be one of the highest performing assets out there. And so I also say to people, the only wrong allocation to Bitcoin is zero. Because I sincerely believe Bitcoin's going to go up 10x, 100x over the next, 15 years. And, even if you only took 1% of your net worth and put it in Bitcoin, if it went up 100x, that's doubling your net worth. And, and if it goes down, if you lose 1%, and it goes to zero, which a lot of people think it might, or some people think it might, fine, you still got the other 99% in gold or whatever else you own. So the point is, you've got this extremely asymmetric asset, and you're also betting on a technical innovation that has never existed before. And so, you want to not own a share in the automobile companies. You want to not. I mean, it reminds me of the other things. It reminds me of the internet so much. It's network-based, right? I mean, I recall very clearly, because I was an investor in it. In the early days of the internet, there were a lot of people like, who really needs this shit? Now, I remember I was an early investor in the PCs. I mean, my first boss in 1981, we had a PC, and we were using it for word processing. It replaced an IBM Selectric, which was a typewriter, the best typewriter of the day. And he's like, yeah, this thing's nice, but the Selectric works pretty well, and why the hell do we need it? I mean, I was like, dude, do you realize all the shit they're going to be able to do on this thing? I mean, they're going to put a spreadsheet. I mean, it's like, right? And look at, I mean, now imagine living today without a PC, right? I mean, you couldn't, right? I mean, imagine, I mean, I remember when we didn't have the internet. Do you know what I mean? And we were doing FedExes, and you wanted information, you had to FedEx it to somebody, or we had fax machines, right? That was how you exchanged information. Well, that's all gone. And so this is just the next technical development in money. And thankfully, because there's a fixed supply of them, it's actually a really sound money. It's a sound and deflationary money. There will only be 21 million Bitcoin. There's $400 billion of fiat wealth in this world. And, there's 12 trillion of gold, and there's $500 million of Bitcoin. Now I'm not suggesting all that money is going to go into gold or Bitcoin, but I am suggesting that if the governments don't act responsibly, and we all know that they're not likely to act responsibly given the way they're set up, that more and more of people's savings will be put into these two areas that will protect them from this, terrible inflation that we're all suffering from. I mean, I went to the grocery store yesterday, and I play this game with myself a lot of times. I go to the grocery store and I wonder how much this basket of goods is going to cost, right? I fill it up with, and I get meat and the normal stuff. And I thought, maybe this is 120. I hope it wasn't that much. I hope maybe this is 120. Maybe it's 125. Maybe it's 130. I went there and I checked. No, it was $180. I mean, right? And I'm guessing a lot of people listening to this are having the exact same experience. And it's like, holy shit, this money's just not buying as much anymore. I mean, it's just not. And so you've got to ask yourself, all right, how do I protect myself from that? How do, and so the answer is you get the soundest money out there, and the soundest money is silver and gold and Bitcoin. And look, for periods of time, because they're volatile, for periods of time, it doesn't feel right. It's going the wrong way. If you bought it at 68 and went to 15, you feel like shit. But what you've got to think to yourself is, no, I've got a longer term perspective on this. I mean, one of the guys, Bill Miller, who owns both Bitcoin and owned Amazon, he owned Amazon right from the beginning. He made billions of dollars on Amazon. But he points out 4 or 5 times in the period of holding Amazon, the stock had gone down 60 or 70%, right? So, he'd sit there and he'd have, I've got $100 million of Amazon. Well, a year later, he had $30 million of Amazon, but he didn't sell it. And that's my point. If you've got a good asset that is going to trend up over time, then you got to live with the volatility because, and believe in your thesis about what's right. So, I would just say to people, make sure you have your savings in things the government cannot print, because I think everyone is going to be shocked by. I mean, we've already been shocked, to be honest with you. I can't believe the price of everything today, and sadly, I don't think that's reversing anytime soon because I don't think these governments are going to get responsible. I think they're going to run this thing right into the ditch, and therefore. I mean, it'll be good for real estate too, by the way. I mean, you can't print real estate, but the negative on real estate is the taxes. I mean, these property taxes are eating people alive, at least in the U.S. I don't know if it's as bad in Canada. So anyway, that's kind of my spiel and I'm sticking with it. When's it going to happen? A lot of people ask me that. I don't know. I think we might have complete fiat failure by as early as 2030, which is 7 years away. It could happen even earlier. But let me tie this back into what I said when we first started speaking. When it happens, it can happen pretty quickly. Silicon Valley Bank was perfectly healthy on March 1st. There were some rumors that they had some trouble in their long bonds, and a few people did the analysis. And then one of the big Silicon Valley venture guys looked at it and said, this thing's not so good. And then he sent out an email to all his portfolio companies and said, if you've got your money at Silicon Valley Bank, I think we should pull it out. And like a week later, it was dead. It's kind of like they all concluded, this is bad, it's dead. Okay. I'm not suggesting that it'll happen the exact same way here, but, the Soviet Union fell. Balaji did a great, people should Google it and listen to the Balaji podcast on this. The Soviet Union was a big, powerful, scary thing until one day it wasn't. It just, and they were lying about the numbers. The parallels between the Soviet Union and our fiat monetary system are actually quite strong. And then one day it just kind of fell apart. And, I could see, and I'm not trying to be a fear monger, and I'm not suggesting people panic, but I could see a scenario where, one day everybody kind of wakes up and something has occurred and suddenly gold's at 3,000 or 4,000. There's not much for sale. And, something's happened with the U.S. government. And, the bond market is selling off hard and interest rates are going up very fast. And then, kind of the way somebody screams fire in a crowded theater, everyone's like, holy shit, this currency is collapsing. I gotta, God, I gotta defend myself. I gotta get out of these dollars. I gotta sell these bonds. I gotta get into something that, and meanwhile, the price of gold is going up really quick. The price of Bitcoin is going up really quick. The price of real estate is going up really quick. And, there's kind of a herd mentality and a self-preservation mentality that suggests that people will really just start piling into this. And, this is how it happened in Weimar, Germany. This is how it happened in Venezuela. This is how it's kind of happening a little bit today in Argentina and Turkey. I mean, currency failure, it starts with inflation, it moves into high inflation, and then eventually people come to realize they can never stop the high inflation, and it moves into, oh my God, get me out of this shit. And right. And in a digital age where the word spreads quickly, just as the Silicon Valley Bank thing, one day the Silicon Valley Bank was fine, a week later it was bankrupt. A similar thing could kind of occur in the monetary system. So, if that's the case and that's a possibility, even if it's a low probability possibility, you definitely want to have some sound money in case that's what happens, right? That's kind of how I see it. So.
Yeah, I think you've laid out really well what could be coming, but in addition to that, how people can protect themselves and make sure that they don't, get caught up in this and get hurt. So I think this was really good. Thank you so much for coming on to explain everything
Well,
to
happy to
us.
do it. I suggest people that if they want to learn more about this stuff, you go to my website. It's free. It's EMA2, Edward Mark Alpha, the number 2.com. We put out our quarterly letters in there where we write about all of this in detail. There's some papers in there on Bitcoin and other things. And I'm on Twitter as Lawrence Lepard. My DMs are open, and we're just trying to educate the world to what we think is kind of an incipient monetary, storm that's coming. I mean, it could be a modest storm. It could be a catastrophe. I don't know what it's going to be, but it's definitely a storm. I mean, when you pay 170 for groceries that you used to pay 100 for, something's wrong. And so I think people need to start thinking through the issues surrounding this storm and trying to understand that, the best way to protect themselves is to be in sound money with their savings anyway. That and that this will, I think, help them make it through a transition that if you're not prepared for, I mean, the stories and where these high inflations have occurred. I mean, there's stories of people who had enough money that they should have been able to live on it for the rest of their life, and it ended up being enough to buy a loaf of bread. You know what I mean? Because the money just got very diluted, and that's the risk that we all face, sadly, as a result of the way the governments have behaved. And it's not a guaranteed risk, but it's not a zero probability risk either.